Hey fellow stock guardians, happy Tuesday, May 25th, 2021. I'm Hoda, Stock Guard CEO, reporting to you from a back in the red stock market. I looked into why the stock market indices dropped today, discussed Apple's fair share price, and researched whether it's time to buy the dip in IAC InterActive stock. The stock market indices ended Tuesday in the red. One of the economic reports we discussed yesterday came out and refueled investors' worries about inflation. The S&P CoreLogic Case-Shiller Index report came out and indicated a 12% jump in home prices in February. We discussed that information quite extensively in the last few episodes. The piece of information that grabbed my attention, in addition to confirmation of inflation, is BlackRock's warning on the lack of attention to the US-China tension and the technological decoupling of the two economies. BlackRock believes investors are ignoring such an important factor, and that could take them off guard. President Biden has continued with President Trump's tough stance on China, and the tension between the two countries has increased. Possible cyber attack or geopolitical unease in emerging countries could be the possible risks to the market that investors are ignoring at this point. We need to consider other possible factors that may drag the stock market down, at least in the short term. Today I was looking at my stock card feed and noticed Apple's stock is fairly priced at this moment. If you go to the company's stock card and click on fair share price, you can see that analysts' price target for Apple is $157 per share, which is quite higher than the current $126 per share. Moreover, looking at its price to earnings ratio of 28, Apple is priced at the same level as its relative sector. The stock is off of its 52-week high of $145 per share, partially due to the legal battle with Epic Games over its App Store fees. If you like Apple for its small 0.66% but a stable dividend, this may be a good time to pick up a few shares. On top of the biggest losers for the day, I noticed IAC Interactive, ticker IAC. Shares were down more than 37%, which is quite unusual for a well-managed company such as IAC. It is a parent company to several internet brands, including investors' favorite Investopedia. It's also the parent company to YouTube challenger Vimeo, who just went public under Vimeo ticker. The problem is that the new IPO didn't get the usual warm welcome IPOs get these days. Take analysts from KeyBank, for example. They don't believe Vimeo can sustainably achieve its long-term revenue target of 30%. Unlike YouTube, Vimeo makes money from enterprise clients who use the platform to publish their video content, and that's why enterprise customers is quite important for analysts. The IPO price fell more than 17% in the after hours, and IAC's stock got hammered. This seems to be a rather over-exaggeration on behalf of investors. Vimeo was about 9% of IAC's 2020 revenue, and it's the 11th IPO spin-off from IAC, which includes Match Group, Expedia, among many other successful IPOs. I'd say IAC would do just fine despite the disastrous Vimeo IPO, at least on the first day. That's it for today. If you haven't already done so, please give a stock card a try. Research as many stocks and ETFs as you want and consider following a few successful investors by visiting the stock pick page on the stock card platform. Don't forget to sign up for a 14-day free trial with promo code ROLLWITHOURCEO, all lowercase and in one word. And as always, help us grow the Stock Guardian community by liking, subscribing, and sharing these daily market recap reports with your fellow investors. I'll really appreciate that, and I'll see you tomorrow.